Hey guys, my name's Max Convexity. Welcome back to my channel. My dog's name is Jax. He's back there somewhere chilling out. Have a great video planned for you today. It's called Max's Theorem. And in this video, we're going to do a little financial math or a little high yield math. I think you guys will like it, so stick around and we'll get right into the middle of it. Alright, Max's Theorem. In this video, I want to put a number to the thing we talk about all the time whenever we're talking about how these high yield funds work and what happens to the NAV and everything, and why they pay the way they do, and how the dividend they pay affects the NAV and how it all goes together. So I'm not trying to make my law of the high yield universe, but I have to make sure I don't violate any of the existing laws of the universe, namely money doesn't grow on trees. There's no such thing as free money. That's the main one. So my law didn't violate that. In fact, I had to keep that in mind when I made my law. So these guys that do these covered call funds have not reinvented the wheel or anything. They haven't solved the risk and reward equation. With risk, you have reward. What a covered call fund does, though, is it can reallocate some of your risk and some of your reward. That's what you can do with any option strategy. All right, so my theory is, or the premise of my theory is that risk is like energy. And of course, energy is neither created nor destroyed. It just simply changes forms. So the same can be said for risk in the market. And I'm thinking that risk is the energy that drives the market. And you could also call risk volatility, because they're the same concept. But this is the energy that drives these markets. I mean, these funds and the market as a whole. So what these guys are doing when they reallocate in a covered call fund, they reallocate some of the risk. These guys are selling calls and taking money in exchange for future upside. We all know that. I know but so they're just reallocating their risk that way. But the risk doesn't go away. It's somebody else has it, or somebody else has a part of it now, not even the whole thing. So I have two parts to my theorem. The first part being the money doesn't grow on trees part, everything has to come from somewhere. It's just return equals dividend plus the NAV. So your total return equals your dividend yield plus your NAV yield, or not really NAV yield, but NAV return. So, but that's just part one. It gets more in depth than that. Part two is that you have to measure the tracking error, and we do that every day on my channel, and you can estimate, and then if you have the tracking error, you can estimate future yields, because you can look at the parent asset. We all know that TSLY's parent asset is Tesla, so you can look at Tesla, and when you do your financial projections, you can project, okay, if Tesla's up 100% next year, and TSLY's tracking error is 75%, that means TSLY will be up 75%. And you can put that into your projections. When you have the tracking error, then you can back into the other ones. And then when you have the 75%, then you can back in and you can see how much TSLY's NAV will be down. When you know TSLY's dividend, then the difference is how much the NAV will be up or down. So you can budget with what the NAV's going to do, and what you expect it to do and what would be normal. I was trying to look for a way to explain that situation. So we can either solve for, if we have tracking error and we can estimate the parent's asset, then we can do the NAV equals the parent asset times the tracking error. These things can only do as well as the parent asset can do. There's no way around that. When it says risk is like energy, and energy is neither created or destroyed, okay, so risk is neither created or nor destroyed. So risk would be destroyed if you could do a covered call fund and it outperformed the parent. That's one of the laws of the universe. We know the covered call funds almost always, over any appreciable period of time, underperform the parent asset. So that's how that part of the law fits in. Is there's no free lunch. We couldn't do a covered call fund, which would give us less risk and get more reward at the same time. Then that would bust the laws of the universe. So keeping that in mind, when you know these things can only do as well as the parent asset, then it makes me appreciate anyway how important it is to pick a parent asset that does well. That's a huge key. That's really a bigger key. Well, or as it is as big of a key as picking one of these funds that has a high yield. I mean, it goes together. You want one that has good performance from the parent asset and high yield, if possible. Okay, so return equals dividend plus NAV. Okay, and then the NAV though, which is also, you could work it that way, is the parent asset times the tracking error. All right, so here's some real simple math. If a high yield fund's total return is 50% and they pay a 50% dividend, what's their NAV return going to be for the year? Yeah, it's going to be 0. So if let's say you have another fund and its total return for a whole year is 25%, which is awesome, but it paid a 50% dividend. So then its NAV performance for the year, NAV yield, NAV whatever you want to call it, would be off 25%. So the NAV would be down 25%, but the investment would still be up 25% on the year because of the dividend. And that's actually, to be up 25% is awesome. That's a huge year. Okay, so, but that's the reason why I put so much emphasis on tracking error. If you have the tracking error, you know what that is, then you can do your projections more accurately, because you can also project what the parent asset will earn, or you can plan for that, multiply it by the tracking error, and you know what to expect from the high yield fund as far as total return goes. But then you can back out the dividend payments, and then you can get what the NAV will be. So, I was going to say, I got a really nice comment about tracking error the other day. Anyway, I didn't clip the comment. I'm not showing it here, but he said that, or the commenter said that I had made up tracking error, and they don't say that in the financial industry, which is probably true. But anyway, and he said I was just doing it for the clicks. And so anyway, of course, I'm not doing it for the clicks. Tracking error is a legit thing and something I really believe in. But yeah, I don't know if they say it in the financial industry. I don't know. I'm a retail trader. We call it tracking error on this station. I don't care what they call it in the financial industry. But tracking error describes the phenomenon that happens, and when it happens to these covered call funds, and you can see it manifest when you see TSLY up 5% on the day, or Tesla up 5% on the day, and TSLY up 3% on the day. And that's how come we follow that every day. I try to show you guys that at the end of every day, and we try to look for outliers. And we ideally, you want a ETF that doesn't have as much tracking error as other ones, and some of these have a lot more than others. And that's how I'm trying to help you or provide value. It's not financial advice, and past performance is definitely no indication of future performance. But at the same time, there's some of these funds that just don't look good, when you put a pencil piece of paper to it. And you have to look at these numbers, and I think my theorem helps figure this out. Now, NAV erosion is a real thing, but it's not what these funds do. NAV erosion and decay are what funds that buy options do, and those funds are inversely correlated to the market. And so when the market goes up, they go down. That's not the way these funds work. These funds just are correlated, but they're less volatile. So when the market goes up, they go up not as far. The market goes down, they go down not as far. They have two things that really hold them back here. The first one being the dividend comes out of the net asset value, and especially these funds that pay huge dividends, that's a real handicap when you're losing that big dividend straight out of the net asset value. But the other hidden cost in these is the tracking error. Tracking error is a serious thing. It's not erosion or decay, but it is a serious thing, and it causes these funds to underperform. In fact, the more tracking error they have, the more they underperform. Now, that being said, some of these funds have very little tracking error also. There's plenty of legit drawbacks to these funds without making up drawbacks. That's all I was saying about the. Let's look at TSLY and TSLA. All right, the yellow is the parent asset, and green is TSLY. Well, you can look. TSLY went from 17 a year ago to 9 just now. In the same time, in the same time, TSLA went from 208 to 199. So TSLA was pretty much unchanged. TSLA was pretty much unchanged. I mean, I guess it was down 8%. All right. TSLA was down 47% in the same time. But it paid such a high dividend, it was still, basically unchanged on the year. In fact, TSLA outperformed the parent asset on the year just a little bit. But that just shows you, the dividends coming out of the NAV is a real thing. But also, the more the dividends pay, you want high dividends, but at the same time, you want a steady NAV. So it's hard to get both. In fact, sometimes you have to sacrifice one or the other. But then the way tracking error becomes involved, instead of just knowing about, okay, if the high yield fund's up 50%, no, let's think about this. Let's say if the high yield fund's parent asset is up 50%, okay, and this is where it comes in handy to have this formula. Okay, if the parent asset is up 50% and the tracking error is 50%, that means the child asset's just up 25%, which is still great. So then you can back out, depending on what the child asset paid for a dividend. Let's say I paid a 25% dividend. Well, then we know its NAV is unchanged on the year. I mean, I feel bad calling this a theorem. There's really not much of a theorem to it. I just try to put a little formula to it. So look at this. If the parent asset was up, say, it would take the parent asset being up 100% in a year for the child asset to be up 50% after you subtract the hidden cost of the tracking error. And then if the child asset paid a 50% dividend, which some of these do, some pay more, then they would still be unchanged for NAV on the year. So to have a steady NAV, you have to have the parent asset go up 100% in this example. So, if steady NAV is something that means a lot to you, these funds are not for you, because the higher the dividend, the more the NAV almost necessarily, or yes necessarily, the NAV will go down. The dividend could still more than make up for the NAV going down, and does. In all these examples, a lot of these funds are kicking ass, but not from a NAV standpoint. Another thing that I hear all the time is, these funds don't make any money though, and that's not true as a a blanket statement. It is true. Last month, QQQY lost 46 cents a share after paying the dividend out, but the month before that, in November and December, they made money. Retire on Dividends tracks it, and I'm going to start tracking it too, just how much they're ahead or behind. And they're behind a little, but I don't think it's something they can't easily catch up from. But we'll see. But I would push back on that theory too, that these things just don't make any money and they're paying all their. Let's look at some more real life examples. So I spent this weekend working on this spreadsheet, and I took a lot of the ETFs in the high yield universe, and I measured them over the last year. And if they're younger than a year, like a lot of the Yield Max ones are and the Defiance ones, I just measured it since inception. And then I also compared it to its parent so we can study the tracking error, of course. Tracking error is an important thing, to be sure. All right. Well, let's look here and let's see how this formula affected different funds payouts. Let's look at OARC. Okay, OARC's NAV was down 25% on the year. Okay, it went from 17 to 13. So that's down 25% of the year. However, it paid a 30% dividend for the year. Total return up 4.63. Now let's look. So for the parent asset, actually ARKK pays a small dividend also. But anyway, you add their small dividend plus their NAV return, they were up 20% on the year. ARKK went from 41 to 50. So the way they made their alpha was through NAV return, 20%, and then they paid less than 1% as a dividend. So they made about 21%, which is a nice year. OARC, did pay a decent dividend, but definitely underperformed. And of course that's what we expect, because you're giving up total return when you do a covered call strategy in return for the dividend. So they traded this 30% dividend for an additional 25 points of upside. So it's a fair trade. I think it depends on your needs. Okay, look at JEPI here. The S&P was up 22% on the year. JEPI total return up 10% on the year. Let's see how JEPI did that. Now JEPI has only been here. Oh no, JEPI's been around for a year. Okay, so JEPI, JEPI, they paid an 8% dividend, and their NAV was up 2%. 2 plus 8 equals 10. So that's a great year, JEPI. S&P, the S&P index, the SPX index pays no dividend. The SPY does pay a dividend. Sometimes I use the SPY for the benchmark. Sometimes I use the SPX. But in this example, it's the SPX. Let's look down here at JEPQ. Now, JEPQ's benchmark is the NDX, of course. Okay, so the NDX pays no dividend, but the NASDAQ was up 43% from last February to Friday. That's pretty good, 43%. It went from 12.3 to 17.6. But didn't pay a dividend. The NDX does not pay a dividend, of course. It's just an index. Well, JEPQ went from 43 to 52. That's respectable. It's up 21%. Then in addition to that, JEPQ paid a 10% dividend. So that 21 plus 10 equals 31. That's how their equation worked out. We can look at this for other ones too. Here's QQQY. This is one I'm interested in, and this is just since last September, since inception. But since inception, QQQY's total return is up 9.22%. All right. The benchmark for triple QY is NDX, of course. NDX in the same time period was up 16%. If you annualize 16%, that projects the NASDAQ being up 39% over the course of the year. But if you annualize QQQY's performance, it comes to 23% over the course of the year. So, the difference between 23 and 39 is the tracking error. That's a 58% tracking error, buffer, whatever you want to call it. It means you have 58%. You get 58% of the performance, both on the upside and the downside. All right, so IWMY here, they've done respectable too. They've only been around since February 1st, and in that time, their NAV is down 10%, granted. They started at 20 and they're at 18, okay. However, in that same time period, and this is just since November, they paid 17.37 in dividends. That's pretty good. So even when you factor in the 10% they're down in NAV, you add in the dividends, they're still a very respectable 6.67%. So here's everyone's favorite, FEPI. FEPI's just been around since October 11th, of course. All right, since October 11th, the Solfang index, which is the index that FEPI is based on, it's the Selective Fang Innovation Index. Anyway, that index is a good index. It's up 26% just since October 11th. But FEPI is up 13%. Now, how did FEPI get that 13%? Because the index doesn't pay a dividend, so that 26%, that all came from capital appreciation. Okay, great. The way FEPI did it, though, is they got about 9% from capital appreciation, and they got another 5%, 4.5% from dividend payments. But you know, that's only a third of a year. That's pretty good to make that much that quick. TLT and TLTW were both down on a total return basis 5 or 6%. There wasn't a whole lot of difference here. The only difference was that one of them pays a dividend and one of them doesn't. Actually, TLT pays a dividend as well, but a smaller one. Pays about a fifth the size of TLTW. But there isn't an instance on here of a covered call fund doing better than the parent. That's not what this is about. These aren't about total return, but there also is not an instance on here of the parent asset paying a higher yield than the high yield fund. The high yield funds were for high yield, but they definitely are not for total return. Now, some of them still have some nice return. It all depends on the parent asset. So let's look down here and see if I can find any other interesting ones. How about old SPY-I? Let's see what happened with SPY-I. Now, they've been around for a year, so we don't have to annualize it. It makes the math easier. Okay, in that year, the S&P's been up 22%. No dividend, of course, so that's all NAV appreciation. All right, SPY-I's got 15.91% total return in that same year. That's great. That's a high tracking error, or so it'll be low error, but it's a good number, 70%. I guess the error part's the inverse. 30% is 30% tracking error. Well, that's good. That's really good. Look, NVIDIA's only been around since May 11th, but it's been doing great. NVIDIA's been up 154% in that time. All right, NVIDIA's up a respectable 66%, with about half of that yield coming from dividend and the other half coming from NAV growth. AMD. Let's see what's going on with that one. That one's only been around since September 19th. Well, AMD's up 71% in that time frame. AMD, as we would expect, total return is about half of that. But what they did is they've paid 23%. They've paid a 23% dividend yield just since November. That's insane. And their NAV's appreciated 8%. They were at 20, of course, when they started, and now they're at 21.67. It's very respectable. All of these look good. I'm tracking all of them. I'll do more videos on and concentrate on other things, other stocks, and that I see. But I wanted to generally show that the formula works. It's all the way across here. Here's column H is N, column I is D, and column J is T. You can see it even works on SCHD. SCHD is not immune from NAV depletion. They paid a 3.46% dividend, and that comes out of their NAV. Their NAV started at 676, is still around 76, but it did have a dividend taken out of it. But it also had a little bit of NAV growth. So that made SCHD up 3% on the year. I use their benchmark as S&P, just to have and compare it with. That's not really a fair benchmark. You know, so these funds, of course, they monetize volatility. We all know that, but they're really also a bet on the parent asset. It's hard to get away from that. I mean, you can't get away from that. So after I did this study and spent all day doing the spreadsheet and looking at how the numbers work together and stuff, I'm starting to appreciate the single stocks more. And the reason is because the single stock has more volatility, which is the reason I didn't like it. And I still don't like it. The more volatility, though, since these guys are monetizing volatility, the more volatility is actually a good thing, because the single stocks are able to go up 150 or 200%. An index is never going to do that. Indexes might be up 20, 30%. Index is up 30 or 40% on the year. It's incredible. The NASDAQ was up 55% on the year last year, and that's incredible, but that's an outlier. There's no such thing as indexes being up 200%. That just doesn't happen. So now I'm starting to get the yield max. I'm just yield max philosophy more. I'm always more worried about the downside, and that's why I like the indexes, because they buffer the downside more, especially with the daily options. But maybe I'm looking at the risk the wrong way. Maybe the downside doesn't matter that much. That what you actually need is more upside participation. So if you use indexes, and indexes just don't have as much upside, so there's not as much upside to get. I may have been looking at the equation from the wrong, I may have been trying to solve the problem from the wrong side of the equation. Yield is the number they put out there. It's a great number and stuff. It's like when you hear somebody that has a business and, we sell $1 million a year, or whatever. We're a, multi-billion-dollar business or whatever. Yes, sales you are. There's a difference between sales and earnings. Some of those businesses are out of business in a few years. I mean, net profits are always what matter, and in the stock market, net profits kind of equal, or they do equal total return. You just have to keep your eye on total return. I would be concerned about QQQY if it was not, if its total return was in the dumps. It has good total return, and all the Defiance funds do. That's what would make me concerned. But the Defiance funds are doing great on a total return basis. When I'm talking about investments, when you allocate capital to an investment, there's an opportunity cost because that money's not in another investment. I'm not talking about either that people should buy these funds or not buy these funds and go on a trip to Vegas. I'm looking at money that you're going to invest anyway. When I talk to my dad about our investments, it's not a choice. Hey, are we going to buy this fund or should we take the money and spend it? No, we're always talking about money that we're going to invest. Now, money that you're going to invest, it doesn't mean you have to invest in the high yield fund at all. But when I get in disagreements with people on the internet, I get the idea that a lot of them, it's just based on a fundamental difference in just the way they're looking at maybe putting some money in, one of these funds, or else doing something with it, or else building an addition on their house or something. And they want to know what's the best of those two options. Well, yeah, that's for them to decide. I'm trying to decide for people that are serious about allocating investment capital. And hey, should you put your investment capital in this investment, or should you put in the other investment? And another disagreement I get in a lot of times on the internet, the person just says, well, yeah, they just need to buy Tesla. Well, of course, everyone should buy Tesla. Yes, Tesla is always going to be better than Tesla. So, I mean, people that have that viewpoint, they just don't like these funds and they think that you should buy the parent asset. Yes, I agree. Depending on your needs, absolutely, the parent asset will always do better than the high yield fund. It's just a matter of the high yield fund, the way they reallocate the risk and the reward and they generate an income stream, it's attractive to certain investors. But if your opinion is that these funds suck because they're never going to be as good as the parent asset, yeah, absolutely. Of course they won't. They'll never have the return of the parent asset because that would be breaking one of the fundamental laws of the universe, the law about there's no such thing as free money. If these funds did perform better than the parent asset, then that would be basically free money. So just remember, it's not financial advice. I like giving advice, and it's fun to talk. Leave me questions in the comments. I'm sure people disagree with some of the stuff I said, but we'll talk about it more later. And I'm also going to show more of that spreadsheet later. I'm going to start showing that spreadsheet on a daily basis, and we'll look at a different stock every day and see how how the risk-reward equation is working out on that particular ETF. A lot of these ETFs have idiosyncratic things about them. I know we have a big week coming up with NVIDIA earnings, and man, I'm excited, or with NVIDIA earnings, which will be big for NVIDIA also. It seemed like 3 weeks ago we had TSLY earnings. I think earnings season ought to be coming to an end pretty soon. We've been in it for a while. All right, guys, remember, not financial advice. If you liked it, you can click the thumbs up or subscribe or do whatever, and I'd appreciate it. But if not, leave me a comment, and I'll try to do it better next time. You guys have a great day.